Two prices, one metal, same planet, same Tuesday morning. Shanghai, 103.016 per ounce. COMEX New York, 89.07 per ounce. That is a $14 gap on the same physical commodity. Shipping costs between the two markets are approximately $1 to $2 per ounce, which means arbitrage traders should be buying silver in New York, putting it on a plane to Shanghai, and pocketing $12 per ounce in pure profit. Rinse and repeat until the gap closes, except the gap is not closing. And the reason it is not closing is the most important thing happening in the silver market right now, more important than the CPI data that dropped this morning, more important than the gold to silver ratio, more important than any analyst forecast from any bank in the world. The gap is not closing because when you try to buy physical silver in New York to ship to Shanghai, you discover something that no future screen is telling you. There's not enough metal to move. The arbitrage that should erase this gap in days has been sitting open for weeks. And every day it stays open is another day the paper market in the West and the physical market in the East are describing two fundamentally different realities. That $14 is not a premium. A premium is temporary. A premium closes when arbitrage flows equalize supply between regions. This gap is not closing because the supply required to close it does not exist at the prices the paper market is quoting. This gap has a different name. It is called a structural break. OG John AG here. This is financial warfare education, not advice. That means we go through both sides completely. We are going to look at exactly why this gap exists, what the inventory data underneath it says, why arbitrage is not closing it the way it should, and what happens historically when a gap this size between paper and physical pricing persists for this long. And we are going to be completely honest about the bear case, because there is a real version of this story where the gap closes downward, where Shanghai reprices toward COMEX rather than the other way around. That argument deserves full respect. Let me show you what the data actually says. Segment 1, Confirmed Facts, March 10th, 2026. Let me start with confirmed facts as of Tuesday, March 10th, 2026. Confirmed. SHFE Shanghai silver price this morning, 103.16 per ounce equivalent in USD. This is the price on China's primary physically delivered silver futures exchange, where contracts require actual metal to change hands. Confirmed. COMEX New York silver spot price this morning, $89.07 per ounce. This is the paper benchmark derived from futures contracts, where the vast majority of positions are settled financially rather than through physical delivery. Confirmed. The gap between the two, $14.09 per ounce, against shipping costs of approximately $1 to $2 per ounce. A net arbitrage opportunity of 12 to 13 per ounce that has been sitting open and has not been arbitraged away. Confirmed. SHFE Silver Vault inventory as of the most recent available data, approximately 423 metric tons, 13.6 million ounces, down from a combined SHFE and SGE peak of over 3,000 metric tons in January 2021, a decline of more than 85% in 5 years. Confirmed. Combined SHFE and SGE Silver Vault stocks have fallen to approximately 631 metric tons, roughly 20.3 million ounces, the lowest combined level in approximately a decade. Confirmed. COMEX registered silver inventory as of the most recent CME warehouse report, 81.2 million ounces, down 64.1% from 240 million ounces in April 2020. Confirmed. COMEX, January 2026, silver deliveries, 49.2 million ounces. COMEX, February 2026, silver deliveries, 25.18 million ounces. Combined 60-day total, 74.38 million ounces, the highest 2-month delivery volume in exchange history. Confirmed. Silver is trading at $89 and change in New York this morning. It has recovered from its $80 local low in 3 consecutive gaining sessions. It opened 2026 at approximately $70. It printed an all-time nominal high of 121.67 on January 29th before collapsing 33% in less than 30 hours following CME margin hikes from 15% to 18%. Confirmed. China has classified silver as a strategic material and restricted its export. This regulatory barrier is one of the structural reasons the 14 arbitrage gap between Shanghai and COMEX has not been closed by normal market flows. Those are the confirmed facts. Everything after this is analysis. That distinction matters. Segment 2, how the two markets work and why they can tell different stories. Let me explain why a $14 gap between two prices for the same metal can exist and persist, because understanding the structural difference between these two markets is the foundation of everything else in this video. COMEX in New York is the Western world's benchmark for silver pricing. It is a futures exchange. Contracts are bought and sold representing silver to be delivered at a future date, but the vast majority of those contracts, historically more than 95%, are never settled by physical delivery. They are rolled forward, cash settled, or simply closed before delivery is required. COMEX prices are therefore a product of financial positioning, dollar movements, interest rate expectations, speculative momentum, and institutional hedging activity. Physical silver does not have to move for the COMEX price to change. The SHFE in Shanghai and the Shanghai Gold Exchange operate differently. These are physically delivered markets where industrial buyers, solar manufacturers, electronics companies, EV producers, chemical processors use the exchange as a direct sourcing mechanism. Physical delivery is a routine, expected outcome rather than an exceptional event. The price on these exchanges reflects what actual buyers of actual metal are willing to pay today for bars they can withdraw from a vault this week. This structural difference is why the two prices can diverge. COMEX is pricing a financial product. Shanghai is pricing physical metal. When the physical market is tight, when industrial users genuinely cannot source the metal they need at the paper price, the physical price rises above the paper price and the gap opens. Under normal market conditions, this gap is self-correcting. Arbitrage traders buy the cheaper paper silver in New York, stand for physical delivery, and ship the bars to Shanghai, where they can be sold at a premium. The supply flow from west to east equalizes regional prices. The gap closes. That self-correction mechanism is currently broken, and the reason it is broken is the most important thing I am going to tell you in this video. Segment 3. Why the arbitrage is not closing the gap. The arbitrage between COMEX and Shanghai sounds simple. Buy cheap in New York, ship to Shanghai, sell at $14 higher, collect profit minus $2 shipping. Here is why that trade is not being executed at the scale required to close the gap. Step 1. Source physical silver in New York. To do this, you either buy it from a dealer at spot plus premium, or you stand for COMEX delivery and take physical bars from the registered vaults. COMEX registered inventory. 81.2 million ounces. Sounds like plenty, but 52.63 million ounces of that inventory were immediately demanded on first notice day for the March delivery cycle. A significant portion of what is reported as registered is already encumbered, allocated, pledged, or subject to existing obligations. The truly free, unencumbered metal available for new delivery is substantially less than the headline 81.2 million ounce number. Step 2. Export the silver from the United States. This step is not frictionless. Export documentation, customs filing, CFTC oversight of large commodity movements, and the logistics of moving good delivery bars in the hundreds of thousands of ounces at a time, all of these add cost, time, and operational complexity that reduces the per ounce profit margin. Step 3. Import the silver into China. China has classified silver as a strategic material and restricted its export. Import, while not prohibited, faces regulatory review and approval timelines that can extend the arbitrage cycle from days to weeks. And in a market where the price gap can close in hours, a week-long import approval process turns a profitable arbitrage into an uncertain one. Step 4. Sell into the Shanghai market. By the time the metal arrives, the gap may have narrowed or widened further. The round-trip uncertainty, combined with the capital tied up in the trade and the financing costs of holding physical metal across borders, makes the arbitrage less attractive than it appears on paper. When arbitrage that should be profitable is not being executed at scale, there are two possible explanations. Either the arbitrage is less profitable than it appears, which the friction costs partially explain, or the underlying supply available to execute the arbitrage does not exist at the required scale. The 74.38 million ounce 2-month COMEX delivery record and the 64% drawdown in COMEX registered inventory since 2020 are both telling you the second explanation is the operative one. Segment 4, the inventory picture. 2 vaults, both draining. Let me show you what the inventory data looks like at both ends of this trade, because the numbers tell a story that the price screens are not reflecting. COMEX registered silver, the metal vaulted, certified, and available for physical delivery, has declined from 240 million ounces in April 2020 to 81.2 million ounces as of March 6, 2026, a 64.1% drawdown in 6 years. The pace of that drawdown has been accelerating. COMEX shed approximately 70 million ounces in just the last few months. On February 11th alone, registered inventory dropped by 3.25 million ounces in a single session, not a data adjustment, not a reclassification, physical metal walking out the door in a single trading day. At the same time, on the other side of the trade, at the destination where the arbitrage silver would need to flow, SHFE silver vault inventory has fallen from a peak of over 3,000 metric tons in January 2021 to approximately 423 metric tons as of early February 2026. That is an 86% decline in 5 years. Combined SHFE and SGE vault stocks, approximately 631 metric tons, 20.3 million ounces, the lowest combined level in roughly a decade, and still shrinking. In a single week recently, SHFE inventories fell approximately 105 metric tons, one of the steepest weekly declines in years. Here is what that dual inventory picture means for the arbitrage thesis. The supply being pulled from COMEX is not flowing to Shanghai to close the gap. It is being absorbed by industrial users, institutional investors, and sovereign buyers whose physical demand is outpacing the exchange's ability to replenish its vaults. The metal is leaving COMEX. It is not arriving in Shanghai in sufficient quantity to close the price gap. It is going into private hands, into industrial supply chains, into vault storage outside the exchange system where it cannot easily be sourced for arbitrage. Both vaults are draining, and the gap between the prices they quote is getting wider, not narrower. Segment 5. What China's industrial demand is actually doing. Let me explain the demand side of why Shanghai is paying $103. Because the gap is not purely a supply story. It is a supply and demand story where both forces are moving in the same direction simultaneously. China is the world's largest industrial consumer of silver. Solar panel manufacturing, electric vehicle production, electronics fabrication, chemical processing, and medical device manufacturing all consume silver as a direct input with no functionally equivalent substitute at scale. The photovoltaic sector alone accounts for a massive share of China's silver consumption. Every solar panel requires silver paste for the electrical contacts that carry current from the cell to the grid. As China has aggressively expanded its solar manufacturing capacity, and as Beijing has tied national energy security goals to domestic solar production, the industrial demand for silver has been growing at a pace that mine production cannot match. China also reclassified silver as a strategic material and restricted its export. This is not a routine trade policy adjustment. Strategic material classification means Beijing has formally determined that silver is essential to national industrial and defense capabilities. You do not restrict the export of a commodity you consider optional. You restrict it when you believe supply is insufficient relative to domestic requirements, and you need to protect what remains inside your borders. The result of these two forces, accelerating industrial demand and strategic export restriction, is that silver available for purchase inside China's exchange system is increasingly scarce relative to what domestic buyers require. When demand exceeds supply in a physically delivered exchange, the price rises until supply appears or demand is rationed. The SHFE is at $103 because that is the price required to clear the market, given the inventory currently available. The $89 COMEX price is not the same market. It is a financial derivative of a physical market that is running out of the metal the derivative claims to represent. Segment 6. The honest bear case. Now the other side, completely and honestly. Bear argument 1. VAT and taxes are not in the SHFE price. Shanghai benchmark silver prices are quoted before value-added tax. When physical metal is withdrawn from exchange warehouses for commercial use, VAT is typically applied. In China, VAT on silver runs approximately 13%. If you add 13% VAT to the $89 COMEX price, you get approximately 157 cents. The actual gap between the real all-in cost in Shanghai and the COMEX price, after accounting for VAT, is approximately 259 rather than 14 ounces. Some portion of what looks like a structural supply gap is actually a tax accounting difference between two markets with different tax structures. This is a real and important point. Anyone presenting the $14 gap without mentioning VAT is giving you an incomplete analysis. The true economic premium over COMEX that reflects physical scarcity, net of tax, is narrower than the headline number. I am presenting it here because it is the single strongest bear argument against the gap thesis, and it belongs in this analysis. Bear argument 2. The gap has existed before without triggering a COMEX collapse. Sustained Shanghai premiums over COMEX are not historically unprecedented. In periods of strong Chinese industrial demand, in 2013, in 2016, and 2021, Shanghai has traded at persistent premiums over Western benchmarks without the paper market repricing to physical levels. The arbitrage frictions I described are real, and they have always been real. A $10 to $14 gap is large by historical standards. It is not without precedent. Bear argument 3. China's strategic material classification could be reversed. Policy decisions can change. If China's silver export restrictions are relaxed, either through diplomatic negotiation or domestic policy reversal, supply flow from China to Western markets could ease the global tightness that is supporting the Shanghai premium. You cannot trade policy risk as if it is a permanent structural feature. Bear argument 4. Shanghai price discovery is not perfect. The SHFE is a physically delivered market dominated by Chinese industrial participants with limited access to global capital. The $103 price may partially reflect a local supply squeeze that does not fully represent global silver availability. If a large new supply source, a significant mine opening, a government inventory release, a sovereign fund selling holdings, directed metal toward China, the $103 could correct faster than the structural deficit thesis suggests. These arguments have real substance. The VAT point in particular is something every retail investor analyzing the Shanghai COMEX gap should understand. The economic premium net of VAT is narrower than the quoted price difference. What the bear case does not resolve, the VAT adjusted premium is still approximately $2.59 per ounce on a commodity with $1 to $2 shipping costs. That is still a persistent premium that should be eliminable by arbitrage, and is not being eliminated. The VAT explanation reduces the magnitude of the gap. It does not explain why the remaining gap is not being arbitraged away. The inventory data, COMEX registered down 64%, SHFE down 86% from peak, is the explanation, and VAT does not change that data. Segment 7. 3 scenarios, honest probability assessment. 3 specific scenarios for how this gap resolves, because the gap has to resolve. Paper and physical cannot price the same metal at different levels indefinitely. Scenario 1, gap closes downward. Shanghai reprices toward COMEX. A policy reversal on China's export restrictions allows silver to flow more freely into the Chinese market from international sources. New mine production, from Morocco, Canada, Mexico projects coming online, adds supply to global vaults. COMEX registered inventory stabilizes as higher prices incentivize eligible silver holders to register their metal for delivery. The Shanghai premium normalizes to $2 to $4 over COMEX on a VAT-adjusted basis. Both markets settle in the $85 to $95 range through Q2. In this scenario, the gap closing downward does not mean a bearish outcome for silver holders. $85 to $95 is still historically high, but it means the structural break was partially a policy-driven distortion that corrected rather than a fundamental supply failure that repriced the metal permanently higher. Scenario 2. Gap persists through Q2. COMEX registered inventory continues declining. March delivery cycle processes at elevated levels, above 40 million ounces. April and May, open interest remains elevated. Shanghai industrial demand does not abate as China's solar and EV manufacturing targets remain unchanged. The VAT-adjusted gap stays above $5. Paper prices in New York begin converging toward physical reality rather than the other way around. Silver moves from $89 toward $100 to $110 as the structural break forces Western paper market participants to price the tightness that Shanghai has already been pricing for weeks. This is my current base case. The inventory data supports it. The delivery record supports it. The Chinese strategic material classification supports it. Scenario 3. Structural break becomes visible. March delivery demand results in publicly reported delivery failures or emergency cash settlement on COMEX contracts that should have been physically settled. COMEX registered inventory drops below 60 million ounces, while open interest equivalent to 200 million ounces remains. The $14 gap widens rather than narrows as the market begins pricing the risk that the paper system cannot physically deliver at scale. Shanghai price discovery begins to replace COMEX as the reference price for industrial users sourcing physical silver. In this scenario, the gap does not close downward or upward in an orderly fashion. It closes through a repricing event. The paper market forced to acknowledge the physical reality it has been ignoring. $150 silver is the first target in this scenario as the gold to silver ratio compresses from 58 toward 40. I am not predicting scenario 3 as the base case. I am telling you that every week the gap stays open and every week the inventory continues draining. Scenario 3's probability increases relative to scenario 1. Segment 8. The ground level signal. Let me bring this from exchange mechanics to the ground level, because the most honest signal is not on the SHFE screen or the COMEX warehouse report. It is in what dealers are actually doing. Online silver dealers in the United States, JM Bullion, APMEX, Gainesville Coins, SD Bullion, have been running premiums on American Silver Eagles well above historical norms. When retail physical demand is strong enough to push dealer premiums to $8 or more over spot consistently, the retail market is pricing what the futures screen is not. More significantly, on February 8th, the Shanghai Futures Exchange shed 31.3 metric tons of silver inventory in a single day, leaving it with 318.54 metric tons. One source reported that a major trader held a 450 metric ton short position against that 318.54 metric ton total inventory. I am presenting this as a reported data point, not as a confirmed fact I can independently verify through primary sources. But the inventory number, 318.54 tons, on the official SHFE data as of February 8th, is confirmed. What is confirmed by primary exchange data? SHFE inventory has fallen by approximately 85% from its 2021 peak. On a per-day consumption basis for China's industrial users, 423 metric tons represents weeks of supply, not months. And those weeks are getting shorter, not longer. The physical dealer at the retail level and the physical inventory data at the exchange level are telling the same story simultaneously. That convergence between the ground level signal and the institutional data is the same pattern that appeared in the Shenzhen $120 buyback price on the weekend of February 28th, when Western COMEX was showing $93. That gap also had a name, and it also resolved by the paper market moving toward the physical reality rather than the other way around. Segment 9, what to actually watch between now and month end. Here's your specific watch list, all public, all free. SHFE Silver Inventory Daily, available through SHFE's official data releases and third-party data providers. If combined SHFE and SGE inventory falls below 600 metric tons, 19.3 million ounces, the physical tightness in China is accelerating. If it stabilizes or rises, the acute phase of the Shanghai squeeze may be easing. COMEX registered Silver Daily Warehouse report from CME Group. If registered inventory continues declining from 81.2 million ounces while March delivery demand processes at the levels first notice day suggested, 52.63 million ounces initially standing, the Western vault is being emptied to meet Eastern demand even through the friction of export regulations and shipping costs. The Shanghai COMEX spread daily. If the $14 gap narrows toward $8 to $10, arbitrage flows are beginning to work despite the frictions. If it widens toward $18 to $20, the structural break is deepening, and the paper market convergence I described in scenario 2 is closer. VAT-adjusted spread. Remember, add approximately 13% to the COMEX price for a real apples-to-apples comparison with the SHFE benchmark. Watch whether the VAT-adjusted gap, currently approximately $2.59, is growing or shrinking. That adjusted number is the true measure of physical scarcity independent of tax structure differences. China export restriction news. Any official announcement from Beijing regarding modification of silver's strategic material classification or export restriction policy is the single event most likely to trigger gap closure downward. Watch official CSRC and MOFCOM announcements. Online dealer premiums. If American Silver Eagle premiums are above $8 per coin over spot consistently through mid-March, the retail physical market in the United States is already pricing the same tightness that Shanghai's institutional market has been pricing at $103. Outro, I sell nothing. No courses, no Discord, no signal groups, no affiliate links. If you see my name on a paid service, it is a scam. You find me here on YouTube and on X. Here's where the data puts us on Tuesday, March 10th, 2026. Shanghai is paying $103, $16 for silver. COMEX says $89.07. The gap is $14.09. Shipping costs between the two markets are $1 to $2 per ounce. The arbitrage that should close this gap in days has been open for weeks. The reason it has not closed is not friction costs. Those are real, but they do not explain a $12 net opportunity sitting uncaptured. The reason it has not closed is that the physical silver required to execute the arbitrage at scale is not available in Western vaults at the current paper price. COMEX registered inventory has declined 64% since 2020. SHFE inventory has fallen 86% from its 2021 peak. Combined Chinese exchange stocks are at a decade low and still falling. 74.38 million ounces were delivered from COMEX in the first 60 days of 2026, the highest two-month delivery figure in exchange history. The VAT argument is real, and you should understand it. Net of China's 13% VAT, the true economic premium over COMEX is approximately $2.59 per ounce, not $14. Even that narrower gap, sitting against $1 to $2 shipping costs, represents a persistent premium that arbitrage should eliminate, and is not eliminating. Two markets, one metal, different prices. One of them is pricing a financial derivative of physical silver, using futures contracts that mostly never result in delivery. The other is pricing actual metal that industrial buyers are taking off shelves in a country that has declared silver a strategic material and restricted its export. The direction of convergence between these two prices is not guaranteed, but every week the inventory drains further, on both sides of this trade simultaneously. The buffer available to the paper market for absorbing physical demand without repricing gets thinner. Watch the SHFE inventory daily. Watch the COMEX warehouse report. Watch the Shanghai COMEX spread. And when the gap finally starts closing, pay very close attention to which market is doing the moving. This is financial warfare education, not advice. Pull the SHFE data yourself. Check the COMEX registered inventory, and never confuse a paper price with what a real buyer is willing to hand over for real metal on the other side of the planet. Drop OG John AG in the comments and tell me, do you think the gap closes downward toward COMEX or upward toward Shanghai? I am reading every single comment. OG out.